Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to our latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times best-selling author and the chief global strategist for West Shore Funds. He's the former general counsel of long-term capital management and he's a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. Great to be with you.
We also have with us Alex Stanczyk, Managing Director of Physical Gold Fund. Hello, Alex.
Hi, John. Likewise, great to be here.
Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. And as time allows, we'll do our best to respond to you. Jim, Fed funds futures are used by investors and traders to effectively place bets on the Federal Reserve's upcoming decisions. I see that current analysis of these futures suggests a 68% likelihood of a rate rise in December. So now it's not just the pundits calling for an interest rate rise, it's the markets. Yet, in a recent article, you, Jim Rickards, continue to insist that the Fed won't raise rates, and you cite a mathematical phenomenon to support your view, recursive functions. Now, for those of us like myself who are a bit math challenged, could you help us understand your thinking here?
Sure, I'd be glad to, John. What I do is I try to steer away from, opinions and predictions and all the analysis. And the difference between an opinion and analysis is that if you're doing analysis, you should have something behind it. In other words, you might express a view, and I do express a view. If you ask me right now today, will the Fed raise interest rates on December 17th at the next FOMC meeting, I would say no. But that's not just, and you'll find lots of people who say yes, and obviously the markets expect that. But I don't like to stop there. I like to, as I say, give the analysis behind it, and that involves facts and data and what the Fed itself is saying. I mean, one of my biggest sources for my views on the Fed is the Fed itself. In other words, they've been talking tough. It was really this time last year, November 2014, I did a series of interviews where I said the Fed would not raise interest rates in all of 2015. And at the time, of course, Wall Street was telling you March, then they told you June, then they told you September, now they're telling you December, and I said all along that they wouldn't raise it, but I didn't have a crystal ball, and I wasn't wiretapping the boardroom at the Fed. I was actually listening to what the Fed was saying. The Fed has laid out their criteria for raising rates. It's not a secret. They have a forecast that says 2.5% growth, 2% inflation, and 5% unemployment. Right now, they're missing on two of those three. They're nowhere near 2.5% growth. They're nowhere near 2% inflation. In fact, both of those have been trending in the opposite direction. Yes, it's true that unemployment has hit 5%, but that's really a proxy for a lot of other things that are going on. We did have a blockbuster October employment report. There's no disputing that. That report was strong across the board, but there's good reason to think that they borrowed a lot of strength from November. We'll see what happens on the November employment report that will be released in early December. But that's just one data point. It's an important one, absolutely, and again, there's no denying the strength of it. But when you look at all the other data, world trade, export growth, import growth, real wages, manufacturing indices, etc., quite a few other things, they're all pointing down. They're all pointing to a recession. By the way, a recession at this stage should come as no surprise, because this expansion is 78 months old, which is longer than the average expansion since 1980. Now, bear in mind, the period since 1980 has been one of very strong growth. If you go all the way back to the end of World War II, so what's the average expansion since the end of World War II? The answer is about 38 months. If you say, what's the average expansion since 1980, a very favorable period, the answer is 77 months. This expansion, the one we're in right now, is 78 months old. It may not feel like an expansion. It's actually the weakest recovery on record, but it's a recovery nonetheless, and we have been growing continuously since 2009, since the middle of 2009. So we're 78 months old. Now, recessions don't die like clockwork. Just because it's longer than the average expansion by every metric doesn't mean it's over tomorrow, but it does mean that nobody should be surprised if it is, because it's pretty long. So given all the data, given the length of this expansion, given the fact that we're certainly closer to a recession than not, I think we actually may be in a recession right now, because we never find out until a year or 2 years after the fact, depending on how long it takes the official National Bureau of Economic Research to declare it. But leaving that aside, we may even be in a recession right now and not even know it. That's my view, based on a lot of data, based on a lot of analysis, based on what the Fed says itself, as to why they can't raise rates. Now, you made reference to what we call the recursive function, what I've been using to analyze this. A recursive function is just a fancy mathematical name for a feedback loop. Any feedback loop is one where the output of the equation equals the input of the next iteration of the equation. So you have a simple equation, you get some data, you solve it, you then take that answer and plug it back into the same equation, run it again, get another answer, take that answer, plug it back in, run it again, etc. Over and over. With computers, you can do this 1,000,000 times or 1,000,000,000 times and graph the output, and you get some very interesting results. But basically, any feedback loop or recursive function is an equation that feeds on itself. It can either explode exponentially, it can go to zero and get stuck there. They can do funny things, but the graph of the output is very, very revealing. Now let me talk, without getting into the equations, because there's no need to, let me talk about two feedback loops that are in play right now. The first is the feedback loop between the Fed funds rate and the FOMC action in terms of raising rates. And John, you pointed out that the Fed funds market is giving a 68% likelihood of a rate increase in December. Well, one of the things that the Fed has worked very hard to do for 2 years, over 2 years actually, is to get the market ready for the rate increase. Now, how long have we been hearing about this? Well, we've been hearing about it explicitly for a year, I would say implicitly for 2.5 years, going all the way back to May 2013, the famous taper tantrum, when Ben Bernanke first used the word taper. I'm sure he used a technical term like reduction in long-term asset purchases, but it's taper by another name. So May 2013 was when Bernanke started talking about tapering. December 2013 was when they actually started tapering. They finished the taper in November 2014, but they still had forward guidance, which was a way of telling the market they weren't going to raise rates quickly. And then they removed the forward guidance in March 2015. So they've been tightening by talking for 2.5 years. As of March 2015, all bets were off because they removed forward guidance. And in 50 speeches since then, they've been talking about tightening, but they haven't actually done it. Well, why are they talking about tightening in what is clearly a weakening environment? Well, the answer is they want to get the market ready. They don't want to shock the market. They don't want the market to believe that they won't tighten, then they actually tighten, and then the market's shocked, and then you get some kind of meltdown. That's what they're doing. But the problem is they can't actually pull the trigger because the data won't support it. And until recently, the markets had been expressing that. The markets were saying, well, look, we don't care what you say. We hear what you're saying, but we don't care. We're thinking the same thing. We're looking at the data. We don't think there's any chance you can raise rates. You know, going into the September FOMC meeting, the Fed Fund futures market was only giving it about a 35% probability. Now they're up to over 70%. Now, but here's the feedback loop. The Fed wants the market to get ready. The market's listening to the Fed. So the Fed is raising the odds of a rate hike because they're saying, hey, the Fed really means it this time. I mean, Janet Yellen, she's not kidding around. You know, she said December's on the table. So they raised the expectation. Well, the Fed looks at the raised expectation and says, aha, perfect time to raise rates because now we know we won't be shocking the market for the first time in a long time. The market is actually expecting us to raise rates, so what better time to raise rates? So then they talk tough again. They say, well, we're really going to raise rates. You know, they gave a bunch of speeches today, and the market goes, well, they really mean it, so we're going to raise the expectations. So you have this feedback loop between the Fed talking tough, which causes the markets to raise expectations, and the higher expectations increase the likelihood that the Fed would actually do it because now they know they're not shocking the market, so they talk tough again. So you can see the feedback loop. It goes around and around and around with the Fed funds market giving it higher probabilities and the Fed saying, well, now that you're on the same page as us, what better time to raise rates? There's only one problem, which is the whole thing's absurd. This is a cat chasing its tail. The economy is weak. We're bordering on a recession. Why on earth would you raise rates at the beginning of a recession? Of course, the time to raise rates was 2010, 2011. Back then, the dollar was weak. The economy was doing pretty well, a lot better than it is now. And that was the time to raise rates. Bernanke blew it. He missed a whole cycle. They should have started raising rates in 2010. By 2012, they could have had them up to 1.5%, 1.75%. Then today, now that we're getting close to recession, you could cut rates because you'd actually have room to cut. The Fed missed the raising cycle. Now they should be cutting, but they can't cut because they're at zero, and they're still talking about raising. Two wrongs don't make a right. Just because you blew it in 2011 by not raising rates then doesn't mean you should blow it again by actually raising rates when the economy's weak. You're tightening into weakness. Now, having said that, we're talking about the Fed here, so don't underestimate the ability that they could screw this up twice, but which is actually, given the fact that the Fed usually messes things up, then you can't rule that out. So what I'm saying is that the data does not support a rate hike. We're probably in a recession or close to one, but the Fed and the Fed funds futures markets are like a cat chasing its tails or two cats chasing two tails, leading themselves to believe they're going to raise rates, which would be an incredible blunder because this would cause an emerging markets meltdown, would cause U.S. stocks to melt down. You're already seeing some of that action in the stock market action of the last couple of days. Now, I said there were two feedback loops. I just described one of them. The other one is between the FOMC itself and actual deflation. So now I'm not talking about what the market expects. I'm talking about what the economy is actually doing. And this is actually the more powerful feedback loop, the one that's been in place since May 2013, and it works like this. So the Fed wants to raise rates because they kind of know they should have done it earlier. They want to get about the business of raising rates, as they say, quote, normalize rates. Whenever people throw that phrase at me, they say, well, the Fed has to normalize rates. I'm like, tell me what's normal about this economy. The Fed's been manipulating markets for 8 years. Tell me what's normal about it. What do you mean by normalization? So that's an aside. Coming back to what the Fed wants to do, they say they want to raise rates, but the Fed also says they want inflation. And that's not a secret. They've told us a zillion times they want 2% inflation. But the problem is when you raise rates, you make the dollar stronger, which is deflationary. Why is it deflationary? Because a strong dollar means we can buy more imports for fewer dollars, so it lowers the dollar price of imports. That feeds into U.S. supply chains. It also hurts exports because if you're buying, starting with a foreign currency, and you have to convert to dollars to buy a Boeing aircraft or a General Electric wind turbine or an Apple iPhone or whatever it may be, you need more dollars because your currency is cheaper. So a stronger dollar hurts exports, which hurts jobs. It cheapens the price of imports, which imports deflation from abroad. The United States is now a big giant magnet for all the deflation in the world. So the Fed says they want to raise rates. The Fed says they want inflation, but raising rates is deflationary because of a strong dollar. So how does that work? Well, the answer is it doesn't work. And what's been happening for the last several years is that the Fed acts hawkish. We're going to raise rates, and then the dollar gets stronger, the economy slows down, the stock market goes down, and the Fed gets spooked. And then they start talking dovish, as they did at the September 17th, 2015 meeting when the FOMC decided not to raise rates. At the time, a lot of people in the market thought they would. They had a dovish press conference, a dovish statement. A couple of weeks later, when the minutes were released, the minutes were super dovish. And then two of the governors, Fed governors, Lael Brainerd and Dan Tarullo, came out with these super-duper dovish speeches. And some of the most, Lael Brainerd just got right in Janet Yellen's face on the nonsense of Nauru and the Phillips curve and a lot of other technical things that economists love to debate among themselves. But the point is, you went through this whole period from September 17th to October 8th when it was nothing but sweetness and light and dovish comments from the Fed. Well, what happened? The stock market went up because all of a sudden they said, well, they're not going to raise rates after all. They're talking like doves. They're talking 2016, maybe indefinitely, and so more cheap money on the way. So stocks went up and markets settled down. Well, what happened next? Well, the Fed looked around and said, looks like the crisis is over. When I say the crisis, I'm going back to August when China devalued their currency, the yuan, on August 10th against the dollar, and that set off a whole chain reaction. Of course, the Shanghai stock market had been melting down since earlier in the summer, but that caused that drawdown in U.S. stocks, 15% decline in a matter of weeks. It reached a kind of almost borderline panic stage right at the end of August. I think it was August 28th or 29th. So the reason the Fed didn't raise rates in September, or one reason, was because the markets were melting down at the end of August. And then that's when they got dovish. Well, when they got dovish, the markets went up. And when the markets went up, the Fed said, aha, all clear. Now we can be hawkish again. So now you got, Yellen, actually she didn't say much today, but Bullard gave a hawkish speech, and Yellen has had other hawkish comments in the meantime, and Dudley the same thing. So what you have is this feedback loop where the Fed talks dovish, markets rally. They take that as a positive sign, an all clear sign. They talk hawkish, and the markets tank again, and the markets tank, and they don't raise. So it's, again, you've got two feedback loops going on. Every time it looks like the coast is clear, that causes markets, for a rate increase, that causes markets and the dollar to react to the rate increase in ways that prevent the rate increase from ever happening. So you're stuck. You're stuck. And the equation for this is a very simple one. S2 equals S1, bracket 1 minus S1 times R, and you can plug in a couple of variables for S1 and R, and crank up the math, and you get a number, and then take S2 and put it in the place of S1 and solve for S3 and run it again and do that enough times, and guess what? It goes to zero and it stays there forever and ever. And so I think the Fed has got them feedback loop, probably several feedback loops, all of which point to zero rate. Where we stand right now, I don't see them raising rates in December. Now, if they do, they don't listen to me. I'm glad our podcast participants do, and some people do, but no reason to think the Fed does. They might blunder. They've blundered all along and raised rates anyway, in which case look for a very serious meltdown towards the end of the year. One more thing, John, which hasn't been written about very much. There's another reason for not raising rates in the middle of December, which is really inside baseball, but the market makers in U.S. Treasury securities are the so-called primary dealers. Primary dealers have to do a lot of what's called window dressing, which is reducing their balance sheet and cleaning up their books for year-end, because that's when they have to do their annual reports and their quarterly reports and tell investors and tell the SEC what they're doing, etc. Well, that window dressing means reducing leverage, which reduces liquidity. This goes back to the old famous Lehman 105 repos that almost brought down the world in 2008. Well, liquidity in the government bond market is a lot worse than people think anyway. So the dealers are privately telling the Fed, don't do this at year end. If you want to raise rates, do it in January. It might be a stupid idea in January also, but it's a lot better to do it in January than February, because the risk of tipping over the markets and causing turmoil, independent of expectations, independent of the recession, just because you're going to mess up the dealers, is very high. So it's the worst possible time to raise rates. You would never want to do it at year end because there's so much else going on in the market. So those are my reasons for thinking they won't raise rates. But if I'm wrong and they do it anyway, which wouldn't be a shock because they've messed up enough things, then look for a market meltdown towards year end.
Well, that's a very intriguing answer, particularly in the last part. Thank you, Jim. Let's return to another favorite topic of ours, the currency wars. We've just had an announcement by China of direct conversion between the yuan and the Swiss franc. To my mind, this could look like a hostile move against the dollar. But isn't China wanting to play nice right now as they're close to getting a seat at the IMF table? By having the yuan incorporated in the SDR, that's the special drawing rights, the IMF's own currency. So, Jim, what is China's game here?
Well, it's a great question, John. You complimented me on a rich answer before. I'll compliment you on a rich question because there's a lot in there. But there's a short answer and a long answer. I'm always good at the long answer, but I'll give you the short answer. Nice with the IMF is not the same as playing nice with the dollar. Remember, the IMF doesn't print dollars; they print SDRs. And so China's play is you're right. It is about playing nice with the IMF, and it is about getting included in the SDR, which will happen. That's on track. But that doesn't mean that it's not bad news for the dollar. And that's what I keep talking about. I keep talking about, when I talk about the death of money or the death of dollar, or collapse of confidence in the dollar, this is not something that that happens overnight. I mean, it can happen over time. It could happen very quickly. It could happen even more quickly than I expect. But it's also something that could play out in small stages over years. And in some ways, that's even more dangerous for your portfolio because people don't notice. The big catastrophe, some people are prepared for it. Probably most people are not. But when it starts to happen, at least the more nimble investors will, get out of the way of a moving train, just jump off the tracks. But with the slow motion decline, slow motion collapse, even savvy investors sometimes don't notice until it's too late. And that's kind of how I see the SDR thing playing out. So let's just talk about China and the IMF and the SDR for a minute, and then I'll come back to how that impacts the dollar. I think a lot of our listeners know that the SDR, I should define it, it stands for Special Drawing Right. That's a geeky, opaque name for what is world money. The IMF prints this world money. You say, why don't they call it world money? Well, the reason is that would probably scare people, so they call it special drawing rights, or SDR, so people don't really understand what it is. It's just another kind of fiat money. The Fed prints dollars, the European Central Bank prints euros, and the IMF prints SDRs. The only difference is that we don't get SDRs in our pockets. SDRs are not what I call walking around money. It's world money used by countries to settle up their debts with each other and settle up balance of payments. And you can use it for other things. You can use it to, no reason why the price of oil couldn't be denominated in SDRs. In fact, I expect sooner than later it will be denominated in SDRs.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.